Hello and welcome. You're tuned into CNBC TV18 Prime. Well, let's get cracking on a brand new edition of the Big C. I'm Nigel, and with me, as always, is Manisha Gupta. We're going to be getting you your daily dose of commodities, cryptos, as well as currencies. Hey, Manisha.
Thank you for that, Nigel. Well, yes, on the show, it's a blockbuster of a one because we have a complete roundup of commodities happening with the Dan Smith of Commodity Market Analytics and Oran van Dort of Rabobank, who'll talk about all things soft commodities. But a quick look at the markets, first of all, Nigel, because they clearly have been quite volatile.
Well, that's right. Stocks on Wall Street, well, they closed the session mixed. The S&P 500 and the Nasdaq, though, scaled new all-time highs intraday. They also closed at record highs, largely aided by pre-earnings jump in Alphabet. Well, we also have Tesla that will be coming out with a set of numbers. Both those two are scheduled for release on Wednesday. Stock futures, well, they're absolutely flattish at this point of time. Asian markets, well, they are mirroring the moves on Wall Street. While back home on the Nifty, we have a bit of a sideways move on the Nifty. We're trading in a bit of a band, plus 50 points to negative 50 points. The good news, though, is we continue to hold onto that 25,050 odd mark.
But when it comes to the crude oil prices, well, we are struggling to find direction onto this one. Today is the third straight day of decline when it comes to the crude prices. Well, they're edging lower as concerns are brewing about the trade war between major crude consumers, the US and, of course, the European Union. They will be talking or they're curbing fuel demand growth by lowering economic activity, which is weighing onto the investor sentiment. And as you can see on your screens, it's more than 0.5% of a decline per piece. The moves on the dollar index also are very indecisive as investors await more clarity on tariffs going forward. And let's take that discussion forward then with Dan Smith. He's Managing Director at Commodity Market Analytics. Dan, hi, thank you so much for joining in. I mean, it's none the wiser really because the way the markets are going right now with extended timelines, whether it comes to tariffs and the way the prices seem to be moving as well. But I do want to start with metals as a sector because it is the industrial metals that are seeing a lot of support at this point in time. It is about China creating that largest hydropower dam. That means a lot of metal would be used in that. China also is talking about more stimulus measures going forward. We've seen a decline in US dollar. The economic data from US and China has been slightly better and metals taking all the support that they can from all of this. What's your sense on industrial metals? From where does China stand? And for the base metal prices, are you a buyer at these levels?
Yeah, I mean, you were talking earlier about the fallback in terms of crude, but I mean, what we got in the industrial metal space is kind of the opposite because, of course, crude's getting suffering in terms of losing demand to the green energy transition effectively, whereas actually copper is benefiting from that. So all this kind of big boom that we've seen in terms of electric vehicles, that's benefiting markets like copper and aluminium in particular. So far this year, we've seen copper kind of and tin actually as well up by about 10% roughly. I mean, there's been a fair bit of volatility, but copper's been doing particularly well. And that really reflects, as you mentioned, the fact that China is doing very well from a macroeconomic perspective. And certainly, I think people are generally too downbeat on China and too pessimistic when you look at things like GDP and industrial production is actually pretty good. And then on the back of that as well, we have this kind of massive boom, which is still going on in terms of EVs. So Chinese EV sales up by more than 30% in the first half of this year. But kind of layered on top of that is this idea that copper is going to be used much more intensively within EVs, not just within China, but within other countries as well. So typically you're going to see about 3 times more copper in a typical EV than you are in a conventional vehicle. So all of that translates more broadly into other base metals, but copper in particular is benefiting from that kind of green energy transition. I mean, you mentioned here this hydro dam. So this fits in nicely into the other kind of bullish story for copper, which is actually the state grid is basically trying to connect up all these disparate sources of green energy. So, talking about hydropower here, but wind and solar as well. There's been a massive expansion in terms of both wind and solar within China. And the state grid is ramping up spending. So they're expected to spend about 650 billion RMB this year on the state grid, up from about 600 billion last year. And that is all going to mean they're going to be building out more power cable, more overhead power lines, and all this stuff is again another quite bullish story for copper and aluminium. So green energy, all very bullish, I think, for the industrial metals.
All right. Hi, Dan. Good to see you, and thanks a lot for joining in. Give us an estimate in terms of global demand for both those two base metals. How much do you estimate the demand growth for copper as well as aluminium? And from here on, what is the price outlook? We have the dollar index that's cooled off. Traditionally, that's good, right, for base metals, and that helps pricing. So help us out with that.
Yeah, absolutely. I mean, I think what we've seen is the dollar's come down, of course, by about 10% so far this year. So in theory, all of the base metals should have got a boost. But in reality, what you've seen is a kind of fairly broad spread of outcomes. So as I say, copper's up by about 10%, aluminium's up by about 2 or 3% roughly, and markets like zinc are actually down by about 10%. So what that's telling you is that actually fundamentals are playing quite an important role in the industrial metal space. So you mentioned about demand growth. So for copper, for example, we've got global demand going up by around about 3% this year. But what you've got really is China growing by about 6%, and the rest of the world pretty stable or kind of flatlining, really. So China is playing its kind of previous role of being the almost exclusive driver of demand growth for copper. And in terms of aluminium, I mean, you mentioned aluminium. The demand growth is also pretty good for aluminium. As I say, it is benefiting from, I mean, we mentioned about EV sales. So, there's going to be a lot more aluminium used in each EV than a conventional car. So both these metals are benefiting very much from this green energy rollout. I mean, the reason why zinc has not done so well is, frankly, because it's not participating in any meaningful way in that story. So zinc itself is, very much more tied to the construction cycle, and in particular the Chinese construction cycle. So it will be no surprise to you at all, Nigel, to talk about these problems in the Chinese construction market. So as we know, house sales are down pretty sharply, and starts in China, and house prices continue to decline. So what that means is zinc is tied into this very bearish part of the story, aluminium and copper tied into the more bullish side of the story that I've just mentioned. I mean, in terms of price targets, I mean, we're actually thinking aluminium and copper will probably decline over the next 3 months. So for copper, we've got 9207 for a 3-month target, and aluminium 2441. So the reason for that is actually partly about seasonality. So typically you see the copper and base metals often pull back over the summer. So often July, August, and indeed September can be quite a weak period from a seasonality perspective. And then probably rallying, we think, copper on a 12-month view. So we think 10,895 on copper, and on aluminium 2721. So we are bullish on both these two on the 12-month view, but bearish on the 3-month view. In terms of zinc, though, because of the poor fundamentals that I've just been talking about, we are actually bearish on that in terms of both a 3-month and a 12-month view. So we've got zinc going down to or targeting 2543 on a 12-month view. So there's this kind of divergence within the complex, reflecting fundamental differences. And as you say, the dollar has weakened, but it hasn't lifted all boats, if you like, at the same time or to the same extent.
Oh, well, absolutely. That's a very, very clear indication that you've given us on the metal prices going forward. But Dan, do talk to us about gold and silver as well, because we're looking at some support coming back here. The markets have seen decline in dollar. Much of the concerns are still on. And then the street is also readying itself for a first interest rate cut, perhaps in the month of September. With that kind of a background, what one are you following? And what is your sense for gold and silver price forecast now by the end of this year and also 2026 first half, if you may?
Yeah, I mean, in terms of gold, I mean, it's been a fascinating journey, right? As you've been speaking about on your show quite a few times recently. I mean, I actually feel that gold is rather overvalued. I mean, I know there's a lot of names on the street that are calling for yet higher gold prices. I suppose the problem for me with gold is the honest answer is we don't really know what the fair value for gold is. So we know that it provides a very useful tool for investors to protect their portfolios. So I think clearly it's been boosted by this kind of safe haven buying effectively. And of course, the dollar's got weaker, which helps. But nevertheless, you know, this kind of everybody's worried about what's going to happen with US policy. I think that's the main thing. So we've never really seen such a kind of chaotic start to a US presidency. So I've done a lot of work in the past looking at what happened in the previous Trump presidency. So generally that was pretty favorable for markets, but the behavior this time around is very much more chaotic. So there's been a massive measures in terms of tariffs and other policies, which frankly changes almost by the day. So it makes it very difficult for people to plan and invest. And people really just look for a safe haven amongst all that chaos. So, clearly we've seen gold doing very well, but also Bitcoin. And personally, I actually think gold is much more preferable than a lot of the cryptocurrencies, mainly because it's been around for thousands of years. It is a very trusted source of a store of value. And, so I wouldn't be particularly bearish on gold. I just think it's had such a good run recently. It's looking rather overextended. And, there's a place for people to have gold in their portfolio. But I think it's also a question of looking for value compared to other assets as well.
So Dan, what's your sense on prices then? You said it's overvalued, but you also said that the fair value for this is perhaps not known given the kind of fundamentals that we're working with. So how would you look at gold finishing this year, and silver as well? What's your sense on prices there? Because most banks and brokerages, as you mentioned, are quite bullish on both of these.
Yeah, I mean, I think, first, I always look at these markets from a kind of trader's perspective, if you like. So it's gold has been very much a trader's market, right? So we've had this very strong run up from the start of this year. We were down at 2,600. We're now up to about nearly 3,400. So we got this kind of brief pause, kind of in this range, roughly 3,200 to 3,400. So that's, some people can say it's kind of flag formation, and the kind of usual technical rule book tells you should see a breakout in the direction of the trend, which is kind of upwards, of course. But those kind of, those kind of signals are rather unreliable, I think. And a lot of it's going to depend on what else happens in the world. So, are we going to see interest rates still rising in the US? What's going to happen with inflation, which I think is fascinating because there's a lot of good commentators saying that inflation is currently building in the pipeline, and that a lot of companies kind of held back from passing through those US tariffs to consumers, but we may well see that coming through in the data in the very short term. So, of course, what that means is upward pressure on US interest rates, which is the last thing that President Trump wants to see. In fact, he wants to see interest rates come back down again.
Sure.
So there's this kind of there's this tension building effectively within the financial system within the US, which is going to be fascinating to watch. So I actually would look to see where the breakout is before trying to follow that trend. I think that's more productive than trying to have a particular target on a market that's very much set up for traders rather than investors. To be honest, in terms of silver, as previous commentators have spoken about, I would look at the gold silver ratio. I don't have a particularly strong view about silver. I think it's a very much tends to follow gold as a kind of high beta play on gold. So, I'm not convinced it has its own separate dynamic, really. So, wherever gold goes, I think silver will tend to follow, depending on the gold-silver ratio.
All right, Dan, very quickly, before we let you go, the commodity that's come back and it's been very volatile is alumina. Alumina has been that, it's been all over the place. I recall a year or so ago, it went to around $800 when we had that supply disruption. And then it halved from the top. But in the last couple of weeks, it's come back to life. How are you reading the alumina demand-supply dynamics? And where is that headed?
Yeah, that's a good question. So we used to assume that alumina was a very well supplied market. So going back a few years ago, before we saw this price spike, everybody assumed that there would always be plenty of alumina. I mean, the main problem is that we kind of underestimated the importance of kind of political risk, really. So we had all these problems in terms of Guinea, which is, of course, the world's biggest producer of bauxite, and therefore that fed into tightness in alumina. Also, I think the Chinese have tended to kind of consolidate some of their alumina capacity as well. So the market has tightened somewhat, um, but we shouldn't forget as well that it does tend to be a kind of the aluminium smelters will often pay a percentage of the aluminium price for alumina. So it does tend to kind of track aluminium itself higher and lower. So we are seeing a little bit of tightness, but I'm not convinced it's going to last for too long. I mean, the key thing really is to, what's going to happen with Chinese smelter output. So we didn't talk about this earlier much, but it's hitting a capacity cap around about 45 million tons per year right now. And that, of course, means a cap on alumina demand. So that will mean that there's less scope for alumina prices, the raw material, to go up. And that means also that, there's a kind of I think the downside is probably rather limited because prices are somewhat, quite a lot lower than they were. But the upside is also capped by this smelter capacity cap in China. So both those things I think are worth keeping an eye on.
Then I'm just going to squeeze in one final question. And the run-up has not just come in the non-ferrous space, but the ferrous metals seem to be running up as well. The best of the gains perhaps have come in steel and iron ore in the last week, 10 days. Are you looking at further strength here?
Yeah, to be honest, I don't follow those as closely. I mean, what we know in terms of steel is a lot of it's going to be about construction activity in China. So there has been these attempts to bail out property developers in China, which is going to, in theory, underpin the construction sector. But the problem with China is it's got this enormous overhang of unsold property. There's been lots of people I've spoken to over the past 6 months to a year where they kind of confirm that a lot of these unsold properties are just being blown up effectively and destroyed. So there's been a total waste of money in terms of spending on housing. And, while the Chinese government's doing what it can, I just think there's such a long way to go before the property market recovers. So that's a big headwind for global steel effectively, and therefore feeds back into iron ore. I mean, on iron ore itself, I don't have a particular view, but I think that's the key thing to look out for really is, where's China going to go? Where's Chinese construction going to go? And, that's what I'd be looking at right now.
Oh, well, yes, there are a lot of ifs and buts, especially when it comes from China. A lot of unsold property, but some start somewhere and some fundamentals adding up for some of those metals at least. Dan, as always, thank you so much for joining in and weighing on for many of those commodities and making sense for some of them and giving price targets as well. We look forward to speak to you soon yet again. But now it's time for a short breather on the show. On the other side, we will be joined by Oran and Dort to talk all things soft commodities, production, prices, volumes, and lots more. Stay tuned. Welcome back. And Oran and Dort, commodity analyst at Rabobank, is now with us on the show. And hi, thank you so much for joining in. And cacao first, and that, as they say, chocolate makes the world go round. But the way we've seen cacao prices in the last couple of years has been very, very volatile. I remember we started 1st Jan 2024 at around $4,200 a ton. And then we went on to see 12,000. We're trading at 8,000 at this point in time. I mean, the kind of volatility that we have for a commodity that is, most consumed around the world. How are you looking at the prices right now?
I mean, to begin with, as you said, it has been extremely volatile recently. In the first half of July alone, I think we saw prices drop about 16%, mostly as a result of increasing certified stocks in Europe, large decline in grindings in Brazil and Malaysia, about 22% in Malaysia, 16% in Brazil, as well as we had grindings data get released on the 17th of July for Europe, North America, and in Asia, which came in at about 9.4%, a decline of 9.4% year on year. And we back then in the beginning of July as well, we had good rainfall and we had a lot of fund selling. And recently we've seen prices actually have a bit of a mini rebound since July 17th, mostly maybe as a correction due to how steep prices had fallen. Once again, a actual drop in European certified stocks, but mostly as we're in a scenario currently of concern for weather, in particular in the two largest producers, Ivory Coast and Ghana, as it has gone dry quite earlier than usual. Cyclically, it's quite dry during August. It's a bit earlier than that right now, and that's raising concerns for the 25-26 main crop development. It's not the end of the world yet, but that's kind of where we stand currently. Yeah, so it's a lot happening.
All right, hi Oran, good to see you, Ben. What about pricing? We hit that fresh peak and then we saw a sharp pullback. What are the trends you're observing in pricing from year on? Say by the end of this year, where are we headed?
I think really to say where we are heading towards the end of the year, it's best to look at the current supply and demand dynamics. We've just come off the back of 3 structural global deficits, the largest thereof being that in the 23-24 season. The deficit is estimated to be at about 492,000 metric tons. And for reference, global production was about 4.4 million metric tons in that year. 2024-25, the current season, is likely to be a 7,000 metric ton deficit. And this is despite those early surplus expectations we saw back in October. And this is mostly due to a decline in production in the two largest producers, Ivory Coast, due to systematic supply side issues such as cacao swollen shoot virus, black pod disease, aging farmers, aging yields, lack of input usage, as well as adverse weather, and these issues exacerbated by years of underinvestment in the sector due to the fixed farm gate model. And as a result, we're in a low stocks and low open interest environment. But if we look forward towards the end of the year, come October, the 25-26 cocoa season will start in the Ivory Coast, the largest producer. And this that season is forecast to produce about 200 to 300,000 metric ton surplus if you look in the market. So if we look at where prices are going, it should be trending downwards in the near term if the surplus materializes, which is in part dependent on the current weather scenario. That being said, with how volatile it is, it could be quite choppy, and price spikes should not be excluded.
Oran, as you mentioned, and as we saw in that data as well, we've seen grindings decline in North America, in Europe, and in Asia as well, for that matter. Is this demand destruction because of the price gains? And how are you looking at demand numbers going forward? You've talked to us about supplies already, but what about the demand?
Yeah, so of course, on the demand front, to begin with, as I just mentioned, the grindings data for Q2 2025 were released in Europe, North America, and in Asia on July 17th. But grindings in general for cocoa are an imperfect proxy for demand, as it could signal low demand, but on the other hand, it could signal that there's insufficient beans to grind, or that beans are being grinded to boost cocoa product such as cocoa butter inventories. Nonetheless, we saw a 7.2% decline in Europe, a 2.8% decline in North America, and a 16.3% decline in Asia. And this is the lowest Q2 grindings since 2016. And if you compare that to a Bloomberg pre-release survey expectations for Europe, the decline was expected or estimated to be about 5%. So it's steeper than that. And this larger than expected decline came despite expectations that grindings would suffer, as we saw a lot of anecdotes from large grinding companies, particularly in Asia, in the quarter, discussing that it was turning sour. We had seen cuts in sales volume guidances of large shotgun manufacturers, and obviously, as I mentioned earlier, the grindings for Brazil and Malaysia also foreshadowed a steep drop. But this had come after resilient Q1 grindings for cocoa, which in Q1 we also saw a drop as well. I think it was 3.5% combined. So this current 9.4% year-on-year drop is much steeper than that. But there wasn't expectations of resilience. But whilst we're seeing grindings in these regions lower, we've also seen a shift to secondary processing countries, and we're seeing that in product export data from Ecuador, as well as greater import of beans in countries such as Turkey, Mexico, and India. As for demand expectations.
Let me come to you with that then. As you said, that the demand in many of these Asian countries seems to be increasing. You mentioned India as well. Is there a demand growth number that you're working with? Until now, the grindings in Europe are followed the most. We've started looking at Asia very strongly now. How are you looking at demand growth, especially coming in from India? And you earlier did mention that the prices can go either ways. But is there a range that you're working with? Because last year's range was 4,000 to 12,000. Is there a range that we are working with for this year?
I think on the demand front, very briefly, I don't expect a growth in demand. I think globally we're expecting a decline for the current season to be about 2%, and we're expecting it to continue declining as these high prices obviously lead to demand destruction. But we're also seeing utilization of shrinkflation and skimflation strategies, a rise in use of weight loss drugs. US consumption is being dampened as well by the current tariff scenario, and we're seeing an increase in market capacity and share of cocoa butter equivalents. So I actually expect a decline going forward in the coming year to these higher prices. But as for prices and where I expect them to head, well, based on this surplus and based off of this rate of demand destruction, contingent obviously on weather and disease for production, I expect prices to trend downwards. But in the short to near term, I'm expecting them to remain elevated compared to those 2010s historic lows, or not historic lows, of 2,500 USD per metric ton. So I expect the range to be a bit higher than that, maybe the 4 to the 5,000 USD per metric ton. So elevated compared to those lows, mostly because we are still seeing systematic supply side issues in the two largest producers, despite this demand destruction that is happening. But if we're looking much further out, it takes about 4 years for a new cocoa tree to produce a meaningful crop. And these high prices are really incentivizing an expansion in production globally, particularly outside of the Ivory Coast and Ghana. So in your Ecuador, in your Brazil, in your Nigeria. And when all these newly planted trees produce their first meaningful crop in 3 years from now, maybe 4 years, we might see a massive oversupply scenario, which could lead to a price collapse, maybe back again to those 2010s lows of 2,500 USD per metric ton. So it's a bit more of a further out view, but nonetheless, I think, as I mentioned, it could go either way. Spikes could happen either way, and volatility will likely very much remain at large, as we are in a low open interest environment, a low stock environment, as we are dealing with tariffs, erratic weather, and as the cocoa market is quite opaque, and we're seeing a lot of unofficial exports in there as well.
Well, you mentioned that all, and well, as you said, I mean, this is a time to sell cocoa, isn't it then? Because we're trading at around $8,000 a ton, and as you mentioned, 5,000, 4,000, and going forward in the next couple of years, we could be looking at much lower rates. So, well, chocolate is back in flavor, clearly. With the cocoa price is expected to decline, we can look at demand going up for sure. Oran, as always, thank you so much for joining in and making sense of what really is happening with cocoa there, where we have seen very, very volatile prices in the last couple of years. But with that, let's wrap on this episode of Big C. This is thank you from me and Nigel and the entire team that put the show together. Thank you for watching.